Well, good afternoon all. My name is Russell Postle and welcome to today's session by BDO on the topics around impacting on not-for-profits and charities. And today we're going to look at the area of GST and income tax with a specific focus on those aspects that impact on the charities and the not-for-profits in particular. Just get my mouse to cooperate. So today I just want to start off with the GST side of things, to look at the broad rules that apply to the entities and GST, to explore the sub-entity option, often a bit underutilized, I think, some fundraising events, and then the general concessions for charities that are available in the GST Act. And then income tax, we'll just touch on a bit of time just looking at the rules that allow a charity or a not-for-profit to actually enjoy income tax exemption. This is not a right, it's an opportunity, and one that must continue to be earned. So, and we'll see that increasingly under scrutiny. We'll just touch base on, for those entities that have deductible gift recipient entitlements, that is, the donation for more than $2 is tax deductible to the donor. A couple of the key things just to make sure that remind everyone as to what they need to do, and some just quick chat around some of the events that fall within the fundraising events for charities. So first off, just looking at the GST, firstly, a reminder that this is a transactions-based tax. Entities are not exempt. It is something that its specific transactions are potentially exempt. And transactions by some entities are granted concessions, and it's those concessions that we'll look at from a broader point of view for the treatment of those particular transactions. So let's kick off with the GST. So one of those areas that often comes into play is that of donations, and whether or not the entity is a gift deductible recipient doesn't really change the nature of the fact that a donation, a gift, will sit outside the scope of GST. But it doesn't mean that a gift that is to a charity, a deductible gift recipient, can't almost fall within the GST net. And that's where the recipient undertakes to perform some activities as a condition of receiving the gift. Then, and that might be referred to as a tied donation. That is that the entity undertakes that the donor says, I'll give you this money, but with this, you must build that new facility. And by the way, if you don't build that new facility, you've got to give the money back. In that instance, then it's more than likely that it would be treated that the supply, that you have a taxable supply occurring, because the entity that's receiving that quote gift unquote, it's more in the nature of a sponsorship and or a grant, and a tied grant to the performance, and the entity is undertaking to do something in return. So it would fail the test as a gift for the tax deductible donor rules, but may still qualify as a grant or a sponsorship. But you could lose 1/11 to GST. So it's important that all donations are strictly donors. Now, you might take note of what the donor is asking, where the donor says, I'd really like you to apply this to this particular activity. And you go, sure, we'll take that on board. And then you go back to them and say, yes, we did actually apply it to that activity. And you do that because you want to ensure that they may turn up with another donation to support that or another activity. So you can certainly take note of and listen to what they say, but if there's anything where you're bound to do it, you're committed, it's a tied donation, then you're going to have the challenge of the GST on that. So a sub-entity, it's something that sits within the GST, and it's unique to purely from a GST purposes. So we're not talking about income tax or anything like that, because everything stays within the entity. So it allows an entity that qualifies, and we'll run through that in a moment, who does, to separate part of their activities and operate them as if they were in a wholly separate entity. So it allows the sub-entity to have a choice to be registered for GST, and that choice is separate to the main entity. And a separate test for the main entity and the sub-entity for the turnover threshold. So you get two looks at the turnover threshold. So it can be beneficial for an entity that has perhaps chosen not to be registered, but is getting close to the turnover threshold of the 150,000 in a 12-month period, looking backwards or looking forwards, and may choose to say, well, if I put this into a separate sub-entity, it's like putting it into a separate entity, but the joy is that you retain the ABN, you're still covered by the insurance policies, all of the governance aspects of the main entity. But for GST purposes only, it lives in this slightly separate animal. So it really does offer an opportunity. So it assists where you've got a strong fundraising component. Now, for many of us, we've had that involvement with kindergartens or schools, if we're supporting our kids or friends. And I'm sure many of you know the game. You cook a cake at home, you take it along, you donate it, and you buy someone else's cake and you take it home. So if that's just organised by the kindergarten, it's a GST registered organisation. If it's done through the kindergarten itself, then there's no input tax credits on the donated goods, and the items that are being sold, like cakes or sausage sizzles, are taxable supplies, and so 1/11 of the sale proceeds are GST. And you can't say, oh, it's only a fate, therefore we shouldn't have to. If it's sold, if the transaction is by the entity itself, then that falls within it. So, the standard sausage sizzle, all your GST-free food, your volunteer labour, but you're producing a taxable supply, a cooked sausage on bread. And as I say, it also assists where you might have a short-term project that takes a particular NFP above the registration threshold. So you can say, well, we can isolate and separate that project and allow that to be done through the sub-entity. So who can access this? My mouse is just not cooperating, sorry. Okay, so who can do this? Firstly, there's the entities listed that are an endorsed charity. Now, this is a defined term under the GST Act. And we'll come to just make sure that you understand what that definition is in a moment. A government school and a DGR registered not-for-profit. So a not-for-profit that has a deductible gift recipient status. Now, that would be organisations like some of your environmental organisations at the moment live out. They're not a charity, but that legislation is currently before Parliament. So we'll gradually see that category of DGR registered NFPs disappear, because they'll all have to become charities. But we'll come back to our specific definition of that in a moment. The other category of entities is those that are not-for-profits that are exempt under the Income Tax Act of Division 50, that's what we'll be looking at that in more detail shortly, but it's only in specific categories. The category of charity, education and science, so that'll pick up your regular non-government schools, will fit within that charity definition, because the schools that are not government schools, they fall within that definition of charity when they're run by a not-for-profit organisation. Community service under 50-10, so that's things like your Rotary clubs, fall within there. 5015 is employee and employer associations, trade unions, employer bodies, the like that exist. 50-40, your primary and secondary resources and tourism. So these are, again, they're not-for-profits, so they have to be physical entities that are running, being clubs, associations or similar, that are around promoting things like the development of agriculture and the development of tourism, etc. And finally, the category of sports, culture and recreation. So your arts, all your sporting clubs. So all of these entities have the ability to select, to fit within the entitlement to use the sub-entity rules. So it's a bit like a branch for GST purposes, because any ordinary business can choose to separate out an activity and make it into a branch, and where it does its own reporting and measurements, but it then gets the ABN with a branch identifier at the end as a /001 or 002 or similar. Whereas with the sub-entity, there's no formal branch identification that's done. So it is a little bit different. So a branch or sub-entity is treated as an entity in its own right for GST registration purposes if, and it's a big if it does certain things. One, it must maintain an independent system of accounting from the main entity. So on some of those that I've looked after, we have two MYOB files, for example, one for the main entity and a separate one for the sub-entity. Now, I would suggest that as part of that independent system of accounting, critical to that is a fundamental to have a separate bank account, so that that lives separately to the main entity. So you have a separate account that feeds into that separate file, and then you can say, well, it has that. And if we go back to the kindergarten example where you have the FATE or something similar that is going to be run as a separate sub-entity, then that allows that you say, well, we'll have a separate bank account for that, and we will have a separate system of accounting. Now, it might be formalized, like where you have a regular ongoing activity run through, so you need something more formalized, like a separate Xero or separate MYOB file. Whereas other times it might be, well, we only run this event once a year, we run it through the sub-entity, so we can live within a spreadsheet-based format for the separate accounting. And then at the end, the sub-entity makes a donation, a gift to the main entity, which sits outside the GST net. So another requirement is that it can be separately identified by the nature of activities carried on or the location of the branch. So the nature of activities could be, well, the kindergarten, this one runs the FATE. This sub-entity, all it does is the annual FATE or similar activity that does, it's all about raising money for the not-for-profit. Another requirement, which is another and, is that it's referred to in the entity's records that it's to be treated as a separate entity for GST purposes. So that's in the minutes of the board or the management committee, confirming that it's going to be run as a separate organisation, as a separate part of it, and if you fail to continue to manage that separate system of accounting or that separate bank accounts, then you've got then the section for dealing with this says that it drops out. Similarly, it must at all times remain a not-for-profit. So it's got to be still governed and controlled by the constitution, the governing rules of the entity, because it's still a part of, it's just a separate cupboard that operates under a separate GST treatment. It's still within the main entity, so it's subject to all of the governance requirements of the main entity as far as accountability and application of everything being to the purpose of the organisation. So what is an endorsed charity for GST purposes? Well, section 176 of in the definitions, close to the definitions area, says that it has to be, there's two requirements. First, the entity has to be entitled to be endorsed, and we'll look at that in the next slide. But it also, the entity must apply for that endorsement. This is not automatic. So the entity, you have to go and ask for it. And so that's an important aspect to ensure that that if you wanted to be treated as an endorsed charity for GST purposes, you need to do that. So you're entitled to be endorsed if you're an ACNC registered charity and you have an ABN. Well, it's pretty hard to be an ACNC registered charity without an ABN, because you need an ABN to start your registration. So, but I guess you just got to make sure you don't let the ABN lapse for any reason or cancel it, as that will cancel both your ACNC registration, but also anything under the GST Act. So it's pretty straightforward to do that. And so I just pulled up one that, here's one off where you can go and look on the Australian Business Register on the ABR. The RFDS Queensland, for example, shows it's public benevolent, and it shows there's the GST concession. So that's being registered as a charity for GST purposes. So then it can access all of the charity rules within the GST Act. So if you've got an organisation that you look after, go and have a look and see, are we registered? Have we applied, or do we need to apply? Another category of special treatment within the GST Act is for school tuck shops, where supplies of food, where they would generally be a taxable supply. Think back to your tuck shop, they make sandwiches, which are taxable. They may cook hamburgers, prepare food, chips, whatever. I guess maybe that's a thing of the past. You're not allowed to have chips anymore, perhaps in some of the tuck shops now. But being that most of the food purchased would be GST free and converted by the volunteer group into being a taxable supply. So rather than having 1/11 of all of the sale value being taxable, you're treating it to be input taxed, which means that you're not claiming the GST on your purchases. But given the fact that that you're putting all of your, you say, well, all your bread, your butter, your meat slices, potatoes, they'll all be GST free as food, but it's when they're converted into a hot food or similar that it becomes taxable. But in order to qualify, the tuck shop the food must be supplied by a not-for-profit body. So it's got to be by the school or a GST subentity. Or through a separate, a lot of schools have their tuck shop through a separate charity registration, through a separate organisation, through as a incorporated association or similar. So it must be through a shop. They call it a shop, so it's got to look and feel like a shop, operating on the grounds of a school, and that school can only supply primary or secondary courses. So it certainly can't extend out into the tertiary level, but it does limit it. So, and again, the NFP body has to have made that election to operate as input tax. So you need to be able to keep that record of, this is the date that we as an organisation chose to do this. So GST fundraising events. Fundraising events can be input taxed. And again, this is something that organisations need to consider when they're looking at organising a particular event. So let's just put it into perspective. You're going to have a fundraising event, say a gala dinner, or perhaps a performance by a part of an orchestra, and let's say we're doing the performance and the orchestra has chosen to donate their time. So your cost is zero, but you're doing it for a particular charitable activity. And so you're asking everyone to pay a significant sum of money to attend that event. So if it's ordinarily taxed, then 1/11 of all of the ticket sales is GST and must be remitted. As compared to if it's input taxed, it's only 1/11 of the costs of the inputs to the fundraising event. So if let's say that take the example where the orchestra has chosen to provide their service pro bono to the particular cause, so therefore there's a zero cost for them, and there's a zero cost for, I'll say there is a cost for the premises that you've had to hire the hall in which it's being conducted. And so that means that you can't claim the GST on the venue hire, but that will be significantly less, much less than the GST on 1/11 of all the ticket sales. So what fundraising events can qualify? Well, firstly, we've got to ask, are we a supplier or an activity in large broad terms that qualifies? So firstly, again, it must be an endorsed charity. There we are. We're back to that same question. Are you endorsed? Are you recognised on, can you see on the ABR that you have the GST concession? So it has to be an endorsed charity, not just a charity. A DGR entity or a government school. And supply relates to a fundraising event. Now that's a defined term and we'll look at that in a moment. What is a fundraising event? The supplier, the school, the entity, the charity, the DGR, whatever, chooses to treat all suppliers as input taxed for this event. So they've actually got to do that somewhere. So and that may just, you don't have to tell the tax office this, you just have it in your working papers that, or as a decision of the committee, that might be the fundraising committee or the organising or the board, says we note that for this particular performance, we have elected to treat it as a fundraising event and to treat it as input taxed. And then you need to ensure that in all the records that that is what it is. So, so that means that if you decide to say, well, this is what we want to do, and you don't include the GST on your ticket sales, but you then claim the GST back on the venue hire, then you haven't met that last condition because it isn't recorded in all events as an event that is input taxed, because if the event is input taxed, then no GST is able to be claimed on the venue hire. So that could then put it at risk, the GST on the whole event. So it's important that you can demonstrate that in all records of the organisation, so the minutes and in the accounting records, that the event is recorded as input taxed. Now there's a further restriction that if the entity holds a DGR, now this can be an endorsed charity that has a DGR registration, as well as an entity that is just a not-for-profit that's relying on its DGR registration to access these provisions. So any entity that holds the deductible gift recipient registration, the above choice of choosing to make it a fundraising event is not available unless the supply relates to the gift deductible purpose of the supplier. So let's look at charities. Charities include schools, but they're not a DGR. But a school has often in the past had a school building fund within its, it might have had it not as a separate legal entity, but within the school school entity. And that's all was the trend for a while there, but under the new, more recent changes, that's all going back to being separate legal entities. But if we found a private school, for example, that's run by a not-for-profit, so it's outside a government school, it has a deductible gift recipient in respect to the school building fund, then what this says is that because it has the DGR status there, this is not available unless the supply, the gala event, the performance, is related to the gift deductible purpose. In other words, the school building fund. So the money can only go to that activity. Other DGR entities, there's quite a number of them that have compartments that are able to enjoy deductible gift status, not necessarily the whole entity. So it needs to be able to link between the fundraising event and the deductible purpose, why you've got the DGR, what is it that you are supplying, that particular one that entitles you to deductible gift status. So what is a fundraising event? Again, defined in the GST legislation, it's conducted for the purpose of fundraising, not for any other purpose, but purely for the purpose of fundraising. So, you've got to be able to show that we're here to make some money. That's what it's all about. And that it does not form part of a series of regular events. Rather, so you can't say, oh, we have it on every month or so. But events that are included in the legislation, examples are things like a fete, a ball, a performance, those sort of events. Alternatively, you can, if you feel as though you're a bit outside the definition, you can apply to the Commissioner to determine if what the activity is that you're looking for is a particular fundraising event. So, but you've got to do that as an application. You've got to apply to the Commissioner for that. So, so you can get that clearance. So fundraising events do offer a bit of an opportunity, but again, it goes back to, firstly, you've got to be that endorsed charity, the DGR holder or eligible entity, or a government school. And the additional area that sits within the GST is that some supplies by a DGR entity. So again, it comes back to the transactions. Some of the transactions can be GST free. That is that, you know, if you're a Kiwi, you'd talk about it as being zero rated. So the GST rate is set at 0 and you get to claim all of the GST input tax credits. So firstly, it must be by these endorsed charity, DGR entity or a government school, and the accommodation. So if it's a supply of accommodation, and this is where your community housing entities sit, where they're supplied by charities as distinct to supplied by state government. So for accommodation, in order to qualify for this GST-free concession, the rent must be less than 75% of the GST inclusive market value. Less than 75% of the GST inclusive market rental. So you need to be able to demonstrate that what is that market value, and the fact that you are constantly staying below the 75. So 75 doesn't qualify, it has to be less than 75 that's being charged, and it needs to ensure that your market value rent is being checked and determined at all times. Some of the government schemes allowed for subsidy supports around the 80%, of course, then that doesn't qualify under this category. Now, other supplies other than accommodation, where you've got this category of the Act referring to nominal consideration, then if it's not anything non-accommodation, has to be for less than 50% of the GST inclusive market value. So you've got to again be able to evidence how did we come up with the fact that the market value is far greater than the price at which we're selling it. And so that is a concession that is there, where you might be providing meals or similar, and you're asking only for, say, a very nominal contribution by the recipient, that you can say, well, the meal is worth X, but we're only asking for 25% of X as the sum, so therefore it qualifies. So again, it comes back to remember that GST is all about the transaction. Does each transaction fit this? So so it's not the fact that, oh, we're a charity, therefore we qualify, because being that the endorsed charity merely allows you to enter the gate and then see whether you qualify or not for the particular transaction. So you could have some transactions where you say, well, we've sold it for 40% of the inclusive market value, and other transactions where you've sold it for 70% or 100% of the market value, in which case on individual transactions, you would lose those that were above the 50%, or 50% and above would lose their GST-free status, and 1/11th would be required to be remitted as GST. So it's a very, how you manage that from an administration point of view is something that you really need to turn your mind to as an organisation. Okay, so next we're going to move on to the income tax considerations, and we're going to look at these two aspects of what are the rules around the income tax exemption, what allows an organisation, a not-for-profit, to have deductible gift rules, but what do they do to have to be income tax exempt on their income? And because not all NFPs are income tax exempt. Not all activities of NFPs may be income tax exempt. So an NFP can do something that causes itself to no longer pass the test, and if that is the case, then it loses the income tax exemption, not just for that transaction, not just for that day, but for that tax year. So it carries a very significant implication. So the income tax exempt fits under it's Division 50 of the Income Tax Act, and there are some specific categories that I've included here. The first one is the -5, the charities, education and science. So it picks up those education, not-for-profit education providers. Remember, these have all got to be not-for-profits. So they've got to have the rule in there about income staying within the organisation, not available for distribution. -10, the Society for Community Service. Again, your Rotary clubs is a good example of that. Community Progress Associations is another community organisation. 15 is the Employer and Employer Association, so your trade unions, your employer association groups. 20 is where it's conduit through to other funds, so we're not going to spend any time on that, nor the government categories, local government, state government, etc., to be income tax exempt. Health, where you've got public hospitals and health insurers, but they have to be carried on by a not-for-profit. And finally, 40-40, your society or association that covers off the promotion of the development of a number of categories, being aviation, tourism. The aviation one probably stems from the original act in 1936, when aviation was a new world thing. It was only a few years after Kingsford Smith had crossed the Pacific. Agriculture, industrial resources, manufacturing, fishing, things like horticulture, aquaculture, they all fit within that. And finally, your 50-45, you're a society or association for sports, culture and recreation. So your sporting clubs, where it's all about the sporting activities, not about other things, culture, your arts associations, and the recreation, the events, activities that are around people having recovery, etc., but that may not be as formal as a sporting organisation. So those various categories are the ones, and we'll look at a couple of these as a little bit further. So the broad requirements for Australian-based charities are that they must have a physical presence in Australia, and they incur their expenditure and purposes principally in Australia. So, and they have to be endorsed as exempt for charities. So this is your charities, right? So the charity has to have its physical presence in Australia and pursue its objectives. Now, there are categories that they can go and apply to the ATO where they want to do primarily overseas aid, but that's a separate category as such. So your standard charity has to pursue its objectives and incur its expenditure. Doesn't matter where it gets its income from, it's where it incurs its expenditure, principally in Australia. And our principally is more than 50%. So for charities, they must be endorsed as exempt from income tax. If we go back to that slide that we had there a little while ago for when we looked at the RFDS one, for example, where do we go back to? Here we go, must be nearly there. You'll see that it shows the income tax exemption. It's an endorsed category. So, and that's given out by the tax office. It's not, today that's not given out by ACNC. It's still given out by the tax office. So when you do your ACNC application, you then goes on to the ATO and they do the separate endorsement. You want to be able to keep that letter because we've had a case where it appeared as though the ATO had given an endorsement of a particular charity that we've been working with, and but they couldn't. The ATO maintained that they'd never formally done it, and therefore, because it had never been formally done, they were not exempt, and by the way, now lodge tax returns and pay all this tax. So it is something to ensure that you've got that evidence of when you're endorsed. And of course, the ultimate is to be able to see it on the ABR that it's recorded that way. So for charities, the three basic requirements are that you must comply with all, that's all, the substantive requirements in your governing rules. You must apply income and assets solely for the purpose for which the entity is established. And you must continue to be registered as a registered charity with the ACNC. And the 50-47, what that says is that if you lose your ACNC registration, if you're a charitable entity and you are not registered as a charity, that there is no other section, no other clause under section division 50 under which you can claim that you are exempt. So if you're a charity and for some reason you lose your ACNC registration, fail to lodge the annual information statements on time, for example, we've seen the ACNC drop many organisations that have not kept their lodgements up to date. So you become a double defaulter, they withdraw your registration, and at that moment, then you've ceased to be registered. So you can't turn around and say, oh, well, that's all right. What we do is we're a community organisation, so we'll just we'll say that we fit under the community service category. But what 50-47 says is that if you are a charity, that is, you are capable of being registered by the ACNC from a definition point of view, then if you're no longer registered under the ACNC, perhaps because of a behavioural issue, then you can't use any other section of Division 50 to claim income tax exemption. So it's an anti-avoidance rule. Now, for those entities that are not charities, you need to comply with, you've got to comply with all of the substantive requirements in the governing rules. You must apply the income and assets, again, solely for the purpose, and we'll come back and talk about a couple of these, what these two lines mean, for the purpose which the entity is established. And instead of maintaining a registration with the ACNC, that they continue to satisfy any registration requirements particular to that class. A good example is that under the employer and employee associations area, for example, they must at all times remain registered with the Fair Work Australia, for example, as a industrial organisation. So if you give up your registration with Fair Work, then you cease to be that class, and hence would lose your income tax exemption. So it's important to understand for each of you, for each of your organisations, which category, which heading. If we go back to that Division 50, you know, can the board, can you point to which one of these is the heading under which you're claiming? And it can't just say, oh, we're just under Division 50. You go, somewhere maybe, because you know, it doesn't cover every not-for-profit. It covers, I mean, every one of the entities that fit under here must be a not-for-profit, but it doesn't mean that every not-for-profit is income tax exempt. There's lots of not-for-profits that remain taxable. So now let's remind ourselves, what does it cover? Well, the income tax exemption covers both ordinary income and statutory income. So ordinary income is just your regular trading receipts, you know, for sporting club, your membership fees, your competition fees, and it covers the statutory income. So that's the example of that. Best example of that is a capital gain, where you've received something that is only made income by virtue of the Income Tax Act somewhere else. So the governing rules, there's a good ruling out that the ATO went through and considered the various aspects of these rules that are now in this Act, because it came out as 2013, shortly after the legislation was introduced for the establishment of the ACNC. They rewrote the Division 50, and they brought in this concept of the substantive requirements of an entity's governing rules. And some of the examples given were they give effect to the objects or the purpose of the entity, confirm the not-for-profit status, the powers and duties of the directors, require the financial statements to be prepared and retained. So it often says you must do financial statements. Set out the criteria for the admission of members, and require register of members, and for the winding up, which traditionally will focus on as to whom it can only go, that it can only be someone that is to another organisation of a like purpose. So it is a clear requirement in there that that the entity must comply with all of the substantive requirements all of the time. So it's important that you can identify, it's valuable for each of you that have got a link to a particular not-for-profit, that you can go and point out and say, what are our substantive requirements? You know, for example, if it says that you'll have the accounts audited, that's a substantive requirement. So you need to then consider, do we change our constitution if the rules no longer require us to do that, to ensure that the constitution or your governing documents cover that going ahead? And the governing rules term covers, because remember that for many charities, The charities include things like church congregations, which don't have the formality of particular constitutions, but are more governed by a set of rules from their particular church. So it's quite a wide, all-encompassing definition to recognise that they're dealing with a wide variety of organisation types. So the second test is that it must apply its income and its assets. Income and its assets. So the income received can only be used in a particular manner, and the assets, the cash at bank, the use of property that it owns. If it owns a house, for example, can only be used for the purpose for which the entity is established. So it's critical that you therefore can point to the object section of the organisation or other constituent documents. For a church group, again, it will be to go and say, well, what are the objects? What are our purpose of our congregation? But it's important that you can. Now, quite often you see that in constitutions that the objects have got a bit of a blending of objects and powers. So you need to ensure that what you're looking for are not the powers, but you're actually saying we're looking for what are the true objects, that delivery of health services, that delivery of education, whatever it might be. What are the objects? Can the board put their finger straight on, these are our objects, so that when we're looking at every transaction, every decision of the board, that we can honestly put hand on heart and say, yes, we are applying everything to our purpose. What is our purpose as per our governing documents? So it must apply its purposes, and that it must make use of it all solely for the purpose. So, and this is a continuous basis that it must do this. It's not something that you just say, oh, we just got to do it occasionally. And to apply. Now that doesn't mean that you can't have retained earnings, and we can have probably have a whole hour of session on what it is around the definition and how you manage retained earnings. In fact, I've done a whole session for that training for other organisations. But it must apply. So it means that you need to be able to evidence that you're doing everything at all times for the purpose for which the organisation is established, and it must be continued to be met at all times. And then it talks about it must be done solely. Now, there's no definition in the context of Division 50 of what solely is, but within the accounting world and taxation world, the term sole or sole as opposed to solely has had very extensive debate and consideration as part of the superannuation laws, because when a super fund is set up, it has what's referred to as a sole purpose test. Its sole purpose is to provide superannuation benefits for its members. And so any other purpose means that it flags that super fund fails that test and is therefore unable to be given its concessional treatment. So those cases have considered things, and basically the definition of sole has come down to sole being 100%. So there is no relaxation of that. It's 100% must be applied to that purpose. Now, take for example, we saw a live example of a sporting organisation that had a bistro, and they were questioned about whether they were remaining tax exempt. And when we looked at their website and looked at things, they were saying, come and eat at our bistro, come and support our family bistro. And so what they needed to do was to bring it together and to link the bistro, because the reality of it was that the money that they raised from the bistro funded the maintenance of the sporting grounds. So they were certainly doing it right. They were applying everything to that purpose. And so what I'm going to suggest to you is that you need to ensure that your fundraising activities, that you do a whole of entity approach, and that you look at things like your website, your annual reports, your management reports, what you say to donors, and for indirect outlays, closing the loop. So a good example, again, if we go back to the sporting body, it has a bistro. That one of the things that we recommended, which they then did, was that on the bottom of the menus in the bistro, it added the text that by dining here, you are helping us deliver sport. You're helping us encourage people to play sport. So, and that's what I refer to there as closing the loop, so that you say, well, okay, the management committee in that organisation is considering it needs to buy a new glass washing machine. Well, it's a sporting body. It's particularly, it doesn't matter what sport, it encourages the participation in a particular avenue of sport. So you then say, well, is the glass washing machine relevant to the delivery of that sport? No, it's not. But is it an essential part of generating the funds to allow the organisation to better fulfil its purpose of delivering sport? Yes. And so the management committee meetings minutes or the board of directors should be, yes, we have signed off buying a new glass washing machine, because by doing so will allow us to generate more income to better deliver our purpose, which is the sporting activity. It's important that everything can be, the loop can be closed to connect all expenditure back to the purpose. You know, in the examples in the ATO, they'll talk about, you know, if you take money out of a check account and put it on term deposit, is that applying those assets for the purpose? No. But why are you doing that? It's in order to generate a higher level of return, which will then be applied to the purpose. So is it an indirect circuit back to the purpose? Absolutely. So it's important that you can do that. So your website, and it's a whole of entity. Think about it, about how do we as a whole of organisation ensure that we're doing the lot, not just you know, that somehow we think we are. We need to ensure that on the website, when you stand back and look at it, does it show that we're delivering on our purpose? Whatever our purpose might be, let's find that in our constitution, make sure that it properly represents what we're doing, and that we can go and look at that with our annual reports. So we're highlighting in there how we deliver our purpose. Our management reports, our regular ones that come to the board or the management committee each month, are we doing that? Are we recording in there our focus on the pursuit of our objects? And this will become increasingly significant. For charities, they have to maintain, they have to lodge what's called an annual information statement, and depending on the size, they may or may not have to lodge their financial statements with either a review or audit, depending on their size. Fail to lodge 2 annual information statements and double defaulter, you're deregistered. That doesn't mean that, hey, suddenly now I'll lodge my forms back and I get my registration back. No, no, no. You go back and you start at square one. You start applying, you've got to start right from the start and reapply for registration. And of course, that loss of registration equals loss of income tax exemption. And the world is changing for non-charity NFPs. In the budget announcement this year, the ATO was announced as one of the statements that the ATO will require income tax exempt NFPs to submit an online self-review form annually. And this is to commence 1 July 23. Now, you know, I can't imagine that they would introduce this without some form of penalty for non-compliance. And it may follow the ACNC rule, you know, double default, 2 years outstanding, bang, you lose your income tax exemption. And funnily enough, as a firm, back in 2009 for the Henry Review, they were considering the question of NFP exemptions, and one of the submissions that BDO put in was to that particular review was the income tax exemption is important in the delivery of purpose of NFPs, but it's fair that the NFPs provide some degree of accountability to evidence that they continue to satisfy the entitlement to be income tax exempt. So there's an interesting commentary from the ATO that for the Division 50, when they're in their comment in that document release as part of the budget statement, the terminology was used there, which was on that screen in the brown. These forms would utilise the information they ordinarily use to self-assess their eligibility. So the ATO's view is that each organisation would be self-assessing their eligibility for the income tax exemption generally on an annual basis, so that the board would sign off saying we're satisfied as part of signing off our annual financial statements, for example, that we are continuing to do everything we need to do to satisfy our income tax exemption. That is, we're complying with all of our substantive requirements of our constitution, we're applying our income and our assets solely to the delivery of our purpose, and we can enunciate exactly what that purpose is. So again, in the ruling examples, the ATO gave the example that what happens if an organisation that was dedicated to supporting homeless women took in some men? Would that cause it to fail its registration? And the answer was that they wouldn't. It does fail, but they may not apply resources to it, provided the organisation fixed their constitution shortly afterwards. So it was that time span that if you fixed it within a very short space of time allows it. If you disregarded it, then it would be read that it would continue to fail, and therefore you'd lose that, even though you may remain totally charitable. You might remain registered with the ACNC, but failing with the ATO. Now for deductible gift recipients, a couple of compliance aspects, and that is that you've got to be able to demonstrate that all DGR gifts and property received, that they're only applied for the purpose for which the entity received its DGR endorsement. So the school building fund can only apply it to the particular projects. A charity that, some charities have DGR for specific activities, and therefore it's worthy that you can compartmentalise that fully and show that we're only delivering it for that purpose. And so that requirement. And then the final one is that a simple thing of failing to issue the proper receipt, the fact that it's the name of the fund or the institution, its ABN, and the fact that it is a gift, if you fail to do that, the ATO may revoke the whole DGR endorsement. They can take away your endorsement. So that brings us to a close today. I don't know whether there's any questions that have come through. Can't see any there, just offhand. So the key things coming back on the income tax is ensuring that you're documenting within the organisation what your objects are, in other words, your purpose, and how you're able to show that you're continuing to comply with that. Build it into your website, build it into everything else. So thank you all for that. Trust you've enjoyed this, and these papers, the slides will be available will be shared with you shortly. So thank you all. Have a good day.